Be very careful who you choose to be your financial advisor. As a matter of fact, in my humble opinion, I don't think you need a financial advisor at all. So I've got a story today about how I was potentially going to work with a Fidelity financial advisor. Fidelity is this large, privately held company that offers a variety of ETFs. They have a brokerage platform, and they have a wealth management unit. And if you want somebody to manage your money, Fidelity is a legitimate place to go. It is legit. Okay, it's not a scam, but the value that you get for your money in the sales pitch that they give you is a little suspect, in my opinion. So when I reached out to Fidelity, I have like $100,000 in my Fidelity account, roughly. And I noticed that, as my account balance was growing towards that $100,000, I noticed that Fidelity was trying to reach out to me to, offer me their financial advisor wealth services. Because obviously, once you reach a certain amount of money, that's when it becomes profitable for them to, become your financial advisor. So I was like, you know what? I'm going to see what these guys have to say, okay? So I scheduled a call with Fidelity. They have an office down in Virginia Beach. And I talked to this chick. Forgot her name. I'm not going to call people's names out. But I talked to this chick, and basically she did the normal standard in processing for, a new client for a financial advisor. So she talked to me about my assets, my liability. She asked me about my income, my age, my risk tolerance. She got the whole, all the details down that she needed to make a rough financial plan. That was the first phone call. But I quickly realized that it's just a massive sales funnel, okay? And the objective of these advisors is to get you into their managed funds, their managed solutions. And they have a sneaky little trick that they use to really entice you. We'll talk about it, don't worry. So the second time that I met a Fidelity financial advisor. So we had the in processing where the girl asked me a bunch of questions, got all my basic information down. The second meeting was with a dude, an older gentleman. And we talked a little bit more, and he verified all the information that the girl collected on the first phone call. And guess what he said? Okay. So I've got a decent amount of assets. I'm not a millionaire. I've got like a little over $500,000 in stock. And the guy was he's very clever. He's a very clever dude. But halfway through our conversation where we were reviewing the portfolio that I had provided to the girl in the first meeting, the guy dropped in a hint that, I would maybe be a good fit for their managed services. Now, Fidelity has multiple tiers. They have multiple different cost structures and whatever. The specific one that they wanted me to get into was a fund that is actively managed. So they have a suite of people that I guess they subcontract that will trade securities for you on your behalf. And they charge you a 0.4% management fee. So to put that into context, 0.4% is roughly, 13 times more expensive than buying the VOO ETF, or about 7 times more expensive than buying the VT Total World Index ETF. So the problem with management fees is they reduce your total returns, because every year you're paying Fidelity 0.4% of your entire portfolio that you have invested with them. And the compounding effect of that 0.4% coming out of your account every year actually significantly adds up over time. It'll really reduce your lifetime wealth. And the higher the fee, the worse it is. But for what they were offering to do, 0.4 wasn't that bad. But they have a very interesting sales pitch. Okay, here's how financial advisors have evolved from when I used to be a financial advisor. So before, we would just, when I was an advisor, we would just, we're going to manage your money and, have extra special attention with good investors watching your portfolio. That was kind of the sales pitch. Now all the advisors have shifted over to tax loss harvesting as their biggest sales pitch. A tax loss harvest is when you sell a security at a loss and you buy another security that is highly correlated with it. So you lock in that loss on your tax return, but you still remain invested. So it's kind of a tax trick in a way. And what Fidelity does, at least with this tier that they were offering me, is they take your money and they invest the money in about, I think they said 200. It depends on what fund you pick. There's a couple different options. You can do like US, international, this, that. They take your money and they invest your money into 200 roughly stocks. And what they do is they individually hold those stocks and they strategically tax loss harvest in order to maximize your tax savings. So for example, they'll buy, I'm just pulling companies out of my butt. They'll buy Microsoft, Apple, Amazon, Meta individually. And then let's say Meta dips and your cost basis is negative. They'll sell Meta and they'll buy Microsoft. And what that does is that locks in a tax loss harvest. The sales pitch is that you will recoup the fees that you are paying Fidelity by the tax savings that you will get from the tax loss harvesting. And they show you all these graphics to say, here's how much you can save. And they even imply that they've beat the S&P 500 on an after-tax basis with their programs. Now, it could be true. I don't know. I mean, I didn't look into it that much. But instantly alarm bells were going off in my head. Because number one, the point of index fund investing is that you're buying the entire haystack. That's the entire point of index fund investing. You're saying, I don't know what the future holds. I believe the market is generally efficient and the prices of the securities are reflecting all known information, and that it is very hard, if not impossible, to really have an edge on the market over your lifetime. So what you do is you buy everything in the stock market and you hold it and you let the market figure out the future. That's index fund investing. What this does is it throws away that concept completely, and it says, okay, instead of buying the $3,000 or $4,000 or 3,000 or 4,000 stocks that are currently traded on the U.S. stock market, we're only going to buy 200. So you're losing exposure to 3,800 stocks because they're only going to buy 200 stocks with the intention of tax loss harvesting. Now, another issue is that tax loss harvesting, it can be beneficial in the short term, and you could save money on your taxes, but you can also get hurt in the long run, because every time you tax loss harvest, you're lowering the basis of your shares. So you're taking the loss now and you're kind of deferring a gain into the future. But every time you tax loss harvest, the future gain when you eventually finally sell those shares is going to be higher because you've lowered your cost basis. So it's a current tax benefit that can be beneficial on your tax return, but it's also, tampered by the fact that you're going to have higher taxes in the future, and God help you, tax rates could be higher in the future. So you could be saving taxes now at the 12% rate. You could be tax loss harvesting, and that flows through to your tax return, $3,000 a year. You could be saving at the 12% rate. And then in the future, now that you have this bigger capital gain built in, let's say they raise, tax rates on investments to double what they are right now. You might be saving, or you might be paying even more tax in the future, offsetting those losses. And then there's no guarantee that they can actually generate the tax loss harvesting that they say they're going to. Because if you're in a bull market and basically every stock is going up, how are you going to tax loss harvest? It's hard to, okay? You're not going to have as many opportunities. But the whole time, they're still charging you the 0.4%. They're still charging that. So there's a lot of issues with this. I'm not saying it can't work. And for somebody that I guess just really wants to focus on taxes, I guess it could be beneficial. But in my opinion, it's not worth the 0.4% that they're taking out of your portfolio. And then the last thing that they recommended, so I got this other guy, he's a younger guy that I started talking to apparently on my last interview with Fidelity. And he was very interesting specimen because he had this very interesting recommendation that horrified me. So I don't have enough taxable money in Fidelity to be able to invest in one of the funds. I think you have to have $100,000 liquid to put into one of the funds. And a lot of my money in Fidelity is in a Roth IRA, so I can't move it out. So what we talked about was potentially selling money that I had in Vanguard, transferring it to Fidelity, and that would allow me to have enough money, $100,000, to invest in one of their funds, which is managed for tax benefits. And I knew at this point that this guy was going to do something stupid. So he asked me, he said, what is the built-in capital gain on your investment? And I did a little bit of research. I looked at my brokerage account in Vanguard, and I saw that I had like $40,000 of built-in capital gains. Do you want to know what this mother, recommended? He said, oh yeah, we should sell it. We should sell it again, take the hit now, and move the money over to Fidelity so he could start collecting commission fees off of my investments. If I were to sell, my income would go up by $40,000, pushing me into a higher tax bracket, number one. And number two, I would have had to pay like $7 or $8 grand in taxes. So this dude, because he was so desperate to get my money so he could start collecting a commission, the fees that they charge, he probably gets a cut. He basically said, oh yeah, we should probably just sell the Vanguard, take a $40,000 gain, pay $7,000 or $8,000 in taxes, state and federal, and then move the money over, and the tax loss harvesting will totally make it up. So he wanted me to sell a diversified total world index fund, make a huge profit, and get slammed on taxes. $7 grand's a lot of money. That's gone. That's a lot of money. So I can move it over to his managed account. And I was like, did you really just recommend that, dude? Seriously? I mean, I could see if it was like a couple grand of gains, but I had $40,000 of built-in gains, and this dude wanted my money so bad that he was willing to recommend to a client, hey, yeah, you should probably do it. It's okay. So that really pissed me off. So I decided to not go with Fidelity. But my advice to you is, you can get tax benefits from Fidelity. It's true. They're not lying. But you got to really do the cost-benefit analysis and say, are you really going to save enough money from tax loss harvesting? And are you willing to take a less diversified portfolio so you can harvest tax losses, which if you have an IRA, the money's in the IRA. You don't tax loss harvest in an IRA. Most of your money, if you're a long-term investor that doesn't need the money, it should be in a tax advantage account. There's a lot of stuff to think about. And in my opinion, it's not worth it. And the fact that he thought it was a good idea to sell at a $40,000 gain and pay $7 or $8 grand in taxes just so he could manage the money was complete BS. Anyway, let me know what you think. Do you use Fidelity? Do you use any other financial advisors? Are they worth it, or do you think the fees are too expensive? I personally don't use any financial advisors, especially after this scenario. Let me know your thoughts. Like, subscribe. Check out the membership for exclusive videos. It's $4.99 a month. Check out the pinned comment for all the services I provide, and have a wonderful, delicious day.